Well, good morning, good afternoon, good evening. Bienvenidos. Buenos dias, buenas noches, buenas tardes. I don't know when you're listening to this, but whenever you are listening to this, hello and welcome to BUS123 Introduction to Investments. My name is Frank Payano, and I am your instructor for this class. All of us at Southwestern Community College are extremely happy and grateful and proud and honored that you are here with us. And particularly me, because I'm the luckiest guy in the world. I get to teach what I love. I get to do as a stockbroker what I love. And I will introduce myself in other parts of the beginning of this semester, either through Canvas or through the class website. But just know that this is my life, and it's a lot of fun. Now, some people might disagree with that, but I hope to show you that, no, investing is an adventure. And we are going to do our best to make this class the best class you have ever taken. And a class that 5, 10, 15 years from now, you'll say, you know what, that class actually helped me. Because we're all on this adventure together, folks. It's the adventure we call life. It's scary, it's crazy, it's joyful, it's heartbreaking, it's absurd at times and awkward. But it's ultimately what we're doing here. It's our lives. And I hope to instill upon you the joy that you can receive from investing. And also, we all want to get rich, right? Well, you know, there's no guarantees, as we will often say, but unless the world ends, you use the techniques and the concepts and the skills that we create in this class, and you should do very well for yourself, assuming the world doesn't end. Okay? So let's get started. By the way, make sure you go through all the introductory material in Canvas and on the class website, and you'll see my introduction to myself, among other things, and you're going to introduce yourself. But let's get started on the material. Slide number 2. Whoops. Sorry about that. Slide number 2. Here we are. First, it doesn't give you much confidence in my abilities, huh? The computer. I'm still working on that copy and paste, folks. You know, I'm waiting for that internet fad to blow over, but so far I don't know. So we'll stick with it. Okay, we'll stick with the technology. It's a gloomy moment in history. Never has the future seemed so dark and incalculable. The United States is beset with racial, industrial, and commercial chaos, drifting we know not where. Of our troubles, no one can see the end. Yeah, did you see this on Skunk News last night? I'm sorry, Weasel News, Badger News. You know, where Sean Hadery is saying that we should make America white again. I mean, make America hate again. No, I'm sorry. Make America great again. No, not Fox News. When was this written? When was this said? Well, if you ask people, they will say, yeah, you know, maybe the Great Depression, World War II, maybe 9/11. You know, they're a little off. This was written by Harper's Magazine, a very influential magazine at the time, in 1847. Did they have serious issues in 1840s? Yes. Do we have serious issues now in our modern world? Yes. But so far, equating serious with fatal, so far, has been incorrect. It doesn't mean that tomorrow the world won't end. We know someday it will. We don't know how. I mean, we know that eventually the sun is going to, if it doesn't explode, the sun is going to continue to get larger and larger and larger until it becomes a red giant, in which case it'll swallow up Mercury and Venus and probably Earth, and the Earth will be uninhabitable. But that's not for another 1.5 billion years, folks. So we have a little bit of time for that. But who knows, tomorrow, meteorite, earthquake, tsunami, who knows what happens? Ebola, Disco could return. That's a serious issue, folks. But so far, it's turned out that the people who are optimistic about the future have been right. And the studies tell us that they're happier, that they live longer. The pessimists might counter, well, they're just not being realistic. And again, the world is going to end someday. We don't know how, we don't know when, but the last 200 years, folks, have been the most prosperous years ever. The standard of living has increased many, many times. The last 20 years have been the most prosperous years in the history of the world. And I'm firmly convinced, assuming we don't blow ourselves up, die in our own waste, whatever, that the next 20, 30, 40 years are going to be even better. Why? Because for the vast majority of people in countries in the world and economies in the world, they understand that, capitalism might just be the worst system ever created, except for all the others. And so they're very happy now to say, look what the United States and Western Europe and Japan has done. We want to do that too. So we're going to see, in my humble opinion, we'll come back in 20 years and see if I was right, we're going to see a many-fold increase in productivity, in the standard of living in people all over the world. Because people in what we now call emerging economies or developing economies, we used to call them the third world, are coming out of poverty for the first time. And their wallets are getting fatter. They have more money in their pockets. And so what do they want? They want Dannon yogurt, and they want Dairy Queen, and they want McDonald's, and Coca-Cola, and Pampers, and Colgate toothpaste, and they want cell phones, and Nike shoes, the things that we in the West have taken for granted for almost 100 years. And this is a very good sign, but it doesn't make it on Skunk News every night. Okay, so we're going to emphasize the positive, but don't worry, we'll when things can give us heartburn, we'll make sure we discuss those too. So let's start on slide number 3 with our discussion of our first chapter. Well, really, it's not just the chapter in the book. It's an amalgamation. It's what I would have created if I were writing an introduction to investments book. So some of it's from chapter 1. In fact, chapter 1 is the best chapter of the entire book, folks. And I talk about the book in the introduction and the syllabus and the like. So make sure you go through that. Remember, there are 2 copies in the library that you can read at the library. But also, just as important as the brief history of risk and return, that chapter 1, is also the overview of the investment universe. Because we start from the very beginning, as I'll say again in just a few moments. And we want you to realize that you do not have to have any prior experience, none whatsoever, when it comes to investing. This is an introduction to investments book. And we will start with the idea that we'll color our studies all semester long. So let's read the quote by J. Kenfield Morley at the bottom of this slide. In investing money, the amount of interest you want should depend upon whether you want to eat well or sleep well. Now, I would have said it a little differently. I wouldn't have used the word interest. I would have used reward or return, because interest is just one type of investment return. But he's absolutely right. You cannot get away from this in investing. You're either going to be able to sleep well because your investments are very safe, or eat well because your investments are going to do better for you than just sitting in the bank. And what we're going to do is we're going to try to find a good balance, something that will allow us to eat well over time, but sleep reasonably well as we invest. And as we're going to see, it's not always easy. As we'll say over and over again all semester long, there's a quote from a very famous investor by the name of Warren Buffett. Investing is simple, but it ain't easy. And now he's a very shrewd gentleman, and that doesn't make any sense, right? How can it be simple but not easy? The simple part is the intellectual part. What you're going to do this semester. Learn about investments. Because investments are actually fairly simple once you break them down. The part that ain't easy has to do with your emotions and controlling your emotions and dealing with your emotions. Because, folks, it's not much fun to watch your investments slide in value. And if you do anything other than the most conservative investments, there are going to be times when they're going to fall. But that's okay. That's all right. We're going to learn how to deal with that. We're going to learn how to deal with those inevitable downturns. And it turns out that if we have a long-term perspective and we don't panic, those downturns are the best things that can happen to us. Huh? What? Relax. Relax. We'll get to that. We'll get to it. But first, let's go to slide number 4, where we ask ourselves, what is an investment? That's a pretty good question, don't you think? Well, there are many definitions, but this is the one out of our book, and I think it's about as good as you're going to see. An investment is any vehicle into which resources can be placed with the expectation that it will generate positive income or that its value will be preserved or increased, or both. See, there are 2 parts of investing normally. There's income, and there is growth. So income, interest, dividends, rent. We also call that cash flow. And then there's the increased value and decreased value, which we call capital gains, capital appreciations, yippee, yippee, and capital losses, boo, hiss. And we will come back to this quote over and over again because Mr. Graham was the father of value investing, he's often called, and he was Mr. Buffett's teacher, Benjamin Graham. He wrote the definitive book on investing called The Intelligent Investor, and we will come back to it often. And it's a book that I want you eventually to read. Don't read it first. It's a little tough to read it first, but it's a great book, and you're going to read it eventually, right? All nod your heads, yes. Very good. Okay, Mr. Graham says, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Yeah, and we'll make a distinction between somebody who is an investor and someone who is a speculator. Another word for speculation is trading. And a speculator is also sometimes called a trader. Not traitor to their country, but trader with a D, T-R-A-D-E-R. Okay? So now, what we're going to do is take a very, very, very high level, looking at the universe from very far away view of investments. Right? Investments come in all shapes, flavors, and sizes. So now get out a sheet of paper and start writing out all these terms because we're going to have to learn them. There's a study guide as we discussed in the beginning of the class website and the beginning of Canvas. So you're going to want to, maybe you want to print out that study guide now. Slide number 5. Types of investments. There are 3 major categories. There are a few more, but these are the biggies. Securities? Yeah, I know it's a bad term. I didn't make it up, but it means anything. When you see or read or hear the term securities, you can think of financial investments. Securities are investments that represent debt or ownership. Now, you know them by bonds and stocks, or the legal right to acquire or sell an ownership interest. What? Those are called derivatives, and we'll discuss those later on. But in other words, securities are financial investments that can be traded and can be turned into cash and bought with cash and can be traded with other investors, other speculators, other traders if they're not investors. And we used to call this class investments and securities. And people would go, but I'm not an administration of justice major. No, not that type of security, not the security that protects you. It's the financial investments. And that's what we're going to spend most of our time on, folks. We're going to spend most of our time on stocks, bonds, mutual funds, and short-term investments. The other major type of investment that we think about when we think about investing is property. Real property? You mean as opposed to imaginary? No. Real property is, by the definition, according to the lawyers, talk to the lawyers, I'm not a lawyer, I'm 3 years of law school and 1 bar exam from being able to give legal advice in the state of California. So in other words, I haven't gone to law school. I took business law a million years ago, and our business law professors are awesome. So you'll know more about business law than I do, because my business law professor was mostly drunk all the time. Yeah, but anyway, real property, land, buildings, anything that's attached to the ground. That's what real property means. And then personal property, such as gold and other precious metals, jewels, jewelry, automobiles, art, collectibles, Beanie Babies, baseball cards. And then a section of investments called commodities, which we'll discuss at the end of this semester. We'll talk about all these at the end of the semester, because it turns out that for the vast majority of us, they're not that important. Now, real estate, in reality, folks, is an entire course unto itself. And we have real estate classes. But the beginnings of real estate investing we can cover fairly quickly, because you're going to need professionals. You can't go it alone. You can't. Some people do, but for the most, especially in San Diego, you need help. And my advice for most people who are interested in property is to work at a property management company. Get a job at a property management company, and you'll learn the ropes pretty quickly. Now, the third major type of investing is not something we think about often, but we do it, hopefully, a lot. And that's personal investments. Education, training, travel. And it turns out, folks, that college is often the best investment a person will ever make. Why? Well, there's a pretty good chance, not guaranteed, that you're going to increase your earning power. But more importantly in my humble opinion, and others in education, we see education as a way of just making you a better person, a better citizen, a more well-informed citizen. Because there may be some politicians that love the uneducated, that want people to be stupid, but that's not what this country, in my humble opinion, let me get up my soapbox, was founded on. We want a well-educated citizenry, so that our society as a whole will be better off in the future. It'll never be perfect. We know that. That's why the Constitution says to create a more perfect union. They knew back then we're never going to get it right, because we're humans, but we certainly want to try. And so you are making in my humble opinion, an awesome investment in yourself by taking this class. You think? I hope so. Okay, let's continue. The next category is whether your investment is a primary asset or a derivative asset. Well, derivatives are a type of, I don't actually call them investments. Vehicles, I think, is a better term. And some people in the industry agree with me. Derivatives are tricky, and they're securities that derive their value from an underlying security or asset. What? Relax. That's all you have to know about derivatives. Plus that they're incredibly dangerous. You can make a lot of money overnight and then the next day lose it all. And examples of those are options and futures. So for now, folks, that is all you have to know about these, is that they derive their value from other assets, other securities. They're extremely dangerous, and options and futures are just two different examples of derivatives. There are others. The more important assets that we're going to discuss this semester are debt and equity. Debt? Huh? Debt is an asset? Well, for the investor, yes. For the investor, debt is an asset because we're the ones who are making the loans. We get to play the part of the bank. These are funds lent in exchange for interest income and the promised repayment of the loan at a future given date. And you may have heard these things called bonds. We're going to discuss bonds later on, folks. Short-term investments, savings accounts, and the like. These are investments that we lend our money, and then the entity that we lend our money to, whether a bank or a company or a government, they promise to pay us a certain interest rate and then pay us back our principal. Equity is the term we often use for ownership. And ownership comes in various flavors. The ones we're going to spend the most time on are stocks. And why is that? Because stocks are where the action is, folks. Stocks give us growth. Stocks allow us to participate in the growth of the global economy now. But stocks are risky. Yeah. Partnerships, sole proprietorships are ways for us to own businesses in a much more personal way than a stock through a corporation. But they're also a whole different world, and we're involved in the business then. In stocks, we're not really involved in the business. We're just passive investors. Real estate ownership, real estate investment trusts. Later, we'll discuss those later. But ways to invest in real estate through an equity, through an ownership position. So you got that? Primary versus derivatives. Derivatives being kind of weird and strange, deriving their value, whereas primary are either debt instruments or equity instruments. Either we're lending our money or we're becoming part owner of the entity. Our next category that we're going to discuss is whether the investment is direct or indirect. Well, a direct investment is an investment where your name is on the investment. They often call it the registration. To whom is this investment registered to? Real estate, stocks, bonds, savings accounts. Whose name is on the account? An indirect investment is an investment where you really have nothing to do with what's going on. You have limited control, or more likely no control, over the underlying investment. Someone else is in control of the investment. And the big examples of this are mutual funds, right? Mutual funds. Sure, you own the shares in the mutual fund, but somebody else is doing the investing for you. And of course, we'll discuss all these things in detail as we continue through the semester. Real estate investment trusts, limited partnerships are also examples of these. You can buy and sell your shares in the mutual fund, in the REIT, in the limited partnership, but you don't control the underlying investments. You're not going to call up the mutual fund and say, "Hey guys, I think you ought to buy Apple." And they'll say, "Thank you very much. We'll pass that on to the investment professionals." Goofball. Slide number 8. Now, this one's a little tricky, folks. Little tricky. Stick with us here. We're used to using the terms international and global interchangeably. But in the investment world, that is not true. You see, there are 3 categories. There is domestic. That's pretty straightforward. Let me see if I can get this to work. It didn't work. There it is. There it is. Domestic investments that are based inside the United States. Yeah, that makes pretty straightforward, doesn't it? And then there are international investments, also called foreign investments. These are investments based outside the United States. And then the third category is global. Global means domestic and international. So get that one straight now, folks. Because if you don't, you're going to look silly when you're talking to other investors. Remember that domestic is based inside the United States. International is based outside the United States, also sometimes called foreign, sometimes called overseas. And then when you add the two together, domestic and international, That gives you global. Todo el mundo. So be careful of this subtle distinction. However, more and more, this distinction is not as important as it used to be. It used to be very important, even just 30, 40 years ago. But now, no. Why? Because the world is global. Here's a great quote from a very experienced mutual fund manager. The world is a very small place these days economically. Huh? Well, according to Forbes, 65% by value of the parts in the Ford Mustang come from the U.S. and Canada. Whereas 90% of the parts in the Toyota Sienna, which is built in Indiana, by the way, come from the United States and Canada, which is the more American car. I mean, how can you get more American than a Ford Mustang? Buy a Toyota Sienna. Right. Yeah, in fact, there are some companies that are based in the United States that don't do any business in the United States. They do all their business outside the United States. There are some companies based outside the United States that do a tremendous, if not the largest part of their business inside the United States. Figure that one out. It's all topsy-turvy. So let's take a look at slide number 9. Let's take a look at these investments. And let's take a look at these companies. They're all stocks, obviously. They're all companies, corporations. Which ones are domestic? Which ones are foreign? Now you can look around and sort of think, I know that's a domestic, I know that's foreign, but I'm not too sure about the others, right? All right. Well, let's think. Huh? Who? Mother Budweiser? Huh? I can't get more American than Budweiser. No, it's a foreign company now. Huh? Yeah, it was bought back in 2008 by a Brazilian-Belgian conglomeration, InBev, and now they're called Anheuser-Busch InBev, and they're based all around the world, but they're no longer an American company. How about Shell Oil, right? They're based in Houston, right? No, they're actually foreign, although they have a huge presence in the United States. It is part of Royal Dutch Petroleum, an Anglo-Dutch consortium that's over 100 years old. How about Ben & Jerry's ice cream? Vermont, right? Not anymore. It's owned by Unilever, a multinational, again, an Anglo-Dutch company that's been around for over 100 years, but is a multinational that's in virtually every country in the world. How about Farmers Insurance? No, actually, it's owned by Zurich, a Swiss company. Arco is Atlantic Richfield. I mean, they're owned by British Petroleum. Gerber is owned by Nestle. And Carnation is owned by, I forget, Unilever, I think. And Compass Soup is owned by Compass Soup is also owned by a foreign company. Where did I write that down? Yeah, Gerber's is Nestle. I'm sorry, Gerber's is Nestle, and Carnation is Nestle, and Compass Soup is, there's that Unilever again. Now Fox Network, right? I gotta be American, right? Fox. If you don't believe what's on Fox News, obviously you is a foreigner, a traitor to this country, or maybe a liberal elite. No, it's actually a foreign company. It's based in Australia. Seagram's is based in Canada. Bayer's based in in Germany. Vaseline in the United Kingdom. Friskies is part of Nestle now. What about Trader Joe's? Trader Joe's, right? I mean, it's a German company now. And 7-Eleven. 7-Eleven is now owned by the Japanese. Figure that one out. Well, it's very simple. If you go back in time, 7-Eleven was started in the Texas area, and it became national, and then they started moving globally, and it turns out that 7-Eleven Japan did just unbelievably well. They turned around and bought the American company. So now all these now Volvo and Saab, obviously, right? Obviously, those are foreign companies. No, actually, folks, Volvo was owned by Ford and Saab was owned by GM, but not anymore. They sold them off, and now Volvo is owned by a Chinese company. I think it's called Geely, and Saab is owned by a company I think it's in the Netherlands called Stryker or some strange. Yeah. Folks, the world is global, and older folks sometimes get upset with this, and they get angry, especially people who who've never really met anybody from another country. But the younger folks don't seem to matter. It doesn't seem to matter as much. They understand that the world is global. We're all in this together. And I know, it might sound, liberal or some ivory tower or bleeding heart to think that, but you don't understand. As investors, we want people to be going out and buying Colgate toothpaste and Pampers and Tide soap. We want them to find a hankering for Jack Daniels. We sell them Marlboro cigarettes. We sell them Kentucky Fried Chicken and Coca-Cola sugar, and then later on we sell them the diabetes drug. Yeah, I want to make money. I'm an investor. I want these companies to do well. And for these companies to do well, it means people all around the world must do well. And I know it maybe sounds like an advertisement for some, for some politician or something like that. But it's the truth. We want the standard of living to rise for everyone. Not only because it's the right thing to do. Everyone deserves food, clothing, and shelter, and internet access. But also, as investors, we're going to make money if that happens. Unless we come along with some other economic system that works a whole lot better than capitalism. And, capitalism ain't perfect, as we've already stated, but it's a whole lot better than everything else. Go ask the folks down in Venezuela now. Yeah, right. So we're going to do it, folks. In fact, let's take a look at slide number 10 and ask ourselves, which country, these are the top 18 countries according to per capita income. They're not the largest economies. We're basing this on the per capita income, what each person earns. I think it's actually gross domestic product, so each person doesn't actually earn that much. It's an average. But still, these are the wealthiest nations per individual. So, sorry about that. Which country had the best average annual return over the past 40-odd years or so, right? Which ones do you think? Well, the answer may surprise you. Sweden, the Netherlands, Denmark. What? These companies have universal health care! They're commies! Not really. They're actually very entrepreneurial, folks, and have some of the best companies in the world. Whereas the United States, not bad, 9.8%, not bad. What's going on with Japan and Italy? Why is Spain and Austria down there? Well, it's not that they don't have very good companies. They do. Some of the best companies in the world are based in those countries. The problem is their populations are stagnant. In fact, I'm not sure about Japan, but I know Italy is shrinking. Japan, I think, is not shrinking, but it's also not growing. Yeah, it's very difficult to grow an economy when your population is shrinking, right? And how have we in the United States created a more population? Through immigration. Oh, my goodness, is that a bad word to use now? But that's how we've done it in the past, and we'll see what happens in the future. So, I'm not going to give up on the U.S., certainly, but it doesn't necessarily mean that it's the best place to invest, huh? We'll return to this, folks, so just keep it under your hat for now. Keep a little mental note of which country had the best average return from 1973 to 2013. Let's continue. Now, the next category we want you to write down on your piece of paper is whether it is a short-term, intermediate term, or long-term investment. And this is really the most important decision, the most important question you need to ask yourself before you make a decision, because that really guides what options are available to you. And these are the guidelines generally used throughout the industry. I take a little bit longer approach, which is what the life insurance industry uses. They use 1 to 2 to 3 years for short term, 3, 5, 6, or 7 for intermediate term, 7, 10, 20, 30 years for long term. But the brokerage, the investment industry tends to use up to a year or so for short term, 2 to 5 years for intermediate term, and then 5 or more for long term. But it depends on you, and I'm a lot older than most of you, and so for me, 3, 4, 5 years, poof, it goes by so quickly. But when you're younger, that's a long time. And Einstein said a long time ago that time was relative, and he's absolutely right. The older you get, the faster it goes. So make sure you commit these. Now you decide which ones you want to use, and remember that they're squishy depending on who you talk to. But remember, short term, 1 or 2 years or so, 2 to 4 or 5 years for intermediate, and then longer than 5 years long term. Slide number 12. Do you have a liquid investment or do you have an illiquid investment? Huh? Liquid? Do you mean wine? Investing in wine? No. Liquidity means the ability to easily and quickly convert your investment into cash. And the investments that we are going to discuss for the most part in this semester are very liquid. Stocks, bonds, short-term investments, mutual funds, real estate investment trusts. There's a ready market to purchase your investment. The change of ownership happens quickly. Mutual funds, it's a day. Stocks, bonds, it's 1 day. Stocks is 3 days. It takes 3 days to change ownership. And so those are liquid investments. Now, what are illiquid investments? These are investments where it may be difficult to convert into cash. The market for the investment is small, or the change of ownership happens slowly, or both. And the poster child for an illiquid investment is real estate. Real estate does not trade overnight, folks. It takes sometimes months for you to sell your real estate property. That's just part of the real estate world. Partnerships, sometimes yes, but usually no. It takes a while to get in and out of a partnership. Collectibles, yeah, sure. Somebody says that these baseball cards are worth that much, but when you actually go to sell them, it's not a very large market. So if you try to quickly change them into cash, you might take a big hit on the price. You have to wait and find another collector who believes that they are worth what you believe they are worth. Make sense? So liquid versus illiquid. Excellent. Well done. What a great class. Slide number 13. Risk and return. Right? We come back to the same question we're going to deal with for the rest of the semester. Do you want to eat well or do you want to sleep well? And we'll spend quite a bit of time on risk versus return in this chapter. Hang on. Risk is the chance that the actual investment returns will differ from the expected returns. Yeah, that's not the typical definition of risk, is it? I mean, when you and I think of risk, we think about the possibility of suffering harm or loss or danger. Well, in the investment world, we talk about losing money and not getting the return we thought we were going to get. In general, the higher the expectation of higher returns, of investment returns, the higher the risk level. And vice versa. The lower the expectation of investment returns, the lower the risk level. Now, these guidelines are not the same as the guidelines you'll read in the book or some other places, but these are my guidelines. And again, remember that everybody has some different guidelines. But low risk is generally 3 to 4 or 5%. Generally, right now it's lower than that, but moderate risk 4, 5, 6. Now, we used to say up to 8%, but now that's even like 4, 5, 6, 7%. High risk, anything above 7, 8, 9, 10%, folks. You're getting into high risk. And again, I put up to 12. And the reason why we'll come back to later, because the market has been doing pretty close to 12% over 100 years. But it's hard to believe it's going to continue to do that. We don't know. We'll find out. But if you're trying to get anything greater than 12%, folks, you are in the speculation world. And I don't consider it investing. Many others don't consider it investing. Certainly, Mr. Benjamin Graham doesn't consider it investing. And I never tell people 11, 12%. I tell people when they invest in stocks, which is, my forte, and you'll you'll hear me talk about stocks a lot this semester, 8, 9, 10% over the long term. Right, over the long term. You have to think long term. Right. So commit these to memory and realize that you can play with them. Maybe they should come down a couple percentage points just because we're in such a low return environment now these days. Slide number 14. Okay, so have you internalized all those? I want you to do that. This is a class, a college class. You need to study. You're going to look at your study sheet, look at the previous slides, and make sure you understand the difference between indirect versus direct and liquid versus illiquid and all the slides that we just went through. So let's now take a few moments and discuss what type of investment is. And then a Bank of America passbook savings account. Passbook. Some banks and credit unions still use a little passbook. Looks like a little passport. Most don't. It's just electronic now. But it's cute. Kids love them because then they go to the bank and then they would take a stamp and mark the date and the amount that they saved. Yeah, Bank of America. So is it a security or a property? Security or property? Let's see if we can use this guy. Yes, it can. Security or property? Right, it's a security. Exactly. It's not property. It's not real estate. It's certainly not a collectible or anything. It's debt. Oh, I'm sorry. I just answered the second question. Is it a debt or equity? Right, it's debt. We're lending our money to Bank of America. And they promise to pay us interest, or not as much these days, and they promise to pay the principal back. Is it a direct or indirect investment? It's a direct investment. Our name is on the passbook savings account. We get to decide what we want to do with it. No one else is making the investment decisions for us. Is it domestic or right? The Bank of America is actually it's not based in San Francisco as it used to be. It's now based somewhere in North Carolina, right? Is it Charlottesville? I can't remember. Somewhere in North Carolina. And then is it short term, intermediate term, or long term? Well, it depends on who you talk to. But in my humble opinion, savings accounts should be considered short term. You should only put money that you need for the next year or so or 2 years in a savings account. Why? Because you're losing the ability to earn more by choosing something a little more aggressive, a little more, take more risk on, yes. But there are others who say, no, I want that money in the bank for the long term. And when you talk to people and they say, oh, I got a couple $100,000 in a savings account, you just go, please take BUS123, Introduction to Investments. Are you going to touch this money anytime soon? Are you going to use it for a down payment on a house? Oh, no, it's my retirement account. When are you going to retire? Oh, no, 20 years or so. You're going to understand the lost opportunity cost by doing that. But, hey, it's their money. They can do whatever they want with it. Is it low, moderate, or high risk? Yeah, it's a savings account. It's low risk, folks. In fact, it is protected by the full faith and credit of the U.S. government, right? If the bank fails, the government comes swooping in and will protect the deposits up to, we're getting ahead of ourselves, up to $250,000. Is it liquid or illiquid? It's very liquid. In fact, they'll give you the money today. Now, if they don't have the cash on hand, they'll say, come back tomorrow, and they'll call the FBI. Yeah, right. I know it's the Patriot Act. And they don't want you dealing in cash. But if you just, and that's what some people did. And at the depths of the Great Recession, people were going to the bank and asking them to take out $77,000. And the bank said, we don't have that much cash sitting in the vault. Come back tomorrow. And then I heard of one woman who said, well, would your guard escort me to the car? No way. We're not going to escort you to the car. You're stupid first to take the money out in cash. Where are you going to put it? In your backyard? Bury it somewhere? Keep it in the bank, folks. Now, what about Nestle? We've already made some reference to Nestle. They own the world. The world's largest, they own the food world. They're the world's largest food company. Right. So are they a security or are they a property? They're a security. They're stock. That's a security. Is it debt or equity? Well, it's equity. We own the shares, which are part ownership of the corporation. Is it indirect or direct? If we own the shares, it's a direct investment. We decide whether we want to sell or hold on to our investment. Is it domestic or foreign? Yeah, it's based in Switzerland. Although, as we've said, these companies are countries unto themselves. Yes, these multinational companies have their roots deep in economies all around the world. Doesn't matter where you go in the world. In the smallest little pueblito in Mexico or somewhere in Africa, you're going to find Nestle Foods, you're going to find Colgate toothpaste, you're going to find Coca-Cola, yeah. What about short-term, intermediate term, or long-term? Well, in general, dear students, as we'll learn, stocks are long-term. Now, Nestle, yeah, you can consider it intermediate term. I would never want to consider a stock a short-term investment unless I were a speculator, a trader. And then you're not really owning the stock, folks. You're basically renting it. You expect to sell it within a few weeks or months or whatever. That's trading, and that's great for some people. We'll discuss the difference between the two in detail in a future chapter. Is it low, moderate, or high risk? Well, in general, folks, stocks should be considered high risk. But Nestle, yeah, we could bump it down into the moderate category because it's Nestle. It's the world's largest food company. They've been around for over 100 and some odd years. Right. Is it liquid or illiquid? Oh, yeah. Stocks in general are liquid, except for just the stocks that we shouldn't even make mention, penny stocks, which are not real companies. They're just scams. We'll discuss those in detail. But no, somebody wants to buy your 100 shares of Nestle. Don't worry, it's a very liquid investment. Okay, now what about the Southwestern College Proposition AA and R bonds and now Z bonds? Right? With the next one, Z, I can't remember. AA, R, they got a couple bond measures. But anyway, Southwestern College, that's us. We went to the world, the South Bay voters, and said, hey, we're Southwestern College. We need to fix up the campus. We want to build a stadium. We want to build a new math center, a new fitness center. We need to fix up the buildings that are falling down. And you know what? We don't want to run a bake sale for that. We need hundreds of millions of dollars. Will you allow us to make these loans? And the voters in the South Bay said yes. They voted to allow us to make these loans. Now, who's paying for the loans? Not Southwestern Community College. The voters are. Actually, the property owners in the South Bay. There's an assessment made to the property taxes that is going to pay for these bonds over the next 30 years. Think of it like a mortgage. And so is it security? Are these security or are these properties? They are security. They are bonds. They can be traded, although many people who buy these, and we'll just talk about muni bonds, hold on to them for the income because it's tax-free. But you can still buy them. You can still buy them and sell them now. Are they debt or are they equity? Well, this is an example of debt. A bond is a loan. We borrowed money from investors, and we have to pay that back. So if you're a bond holder, if you invested in those bonds, you are owning debt. I know it's everything's reversed, right? You're like a bank. You've lent money to Southwestern Community College, and now Southwestern has to pay you back. Is it direct or indirect? Well, if you own the bonds, it's direct. If you own them through a mutual fund, somebody else bought them on your behalf, they would be indirect. But if you own the bonds outright, they're in your brokerage account, they would be direct. You understand the difference? We'll discuss it later on in detail. Domestic or yes, some people call us Tijuana Tech, but there is an Instituto Tecnológico de Tijuana, and it is not us. We are in the United Snakes of Armenia. Right. Is it short-term, intermediate term, or long-term? Well, bonds are either intermediate or long-term. Many people think of them as long-term because all they want is the income. But other people think of them as intermediate-term investments because they're fairly straightforward. They're fairly safe. They go up and down. The value, how can the value of a loan go up and down? To relax, we'll discuss that. And you could think of them as short-term, but really they're not short-term, folks. If you're going to buy a bond, you should keep them at least a few years. Although, again, traders, they might only keep it for a few weeks. Is it low, moderate, or high risk? Well, I would say that we're fairly low. In fact, the rating agencies, the companies that actually give us a credit rating. They give us a pretty darn good high credit rating. So some people might say it's moderate because, there's going to be another real estate downturn. And when there's a real estate downturn, people stop paying their mortgages. And if they stop paying their mortgages, that means they stop paying their property taxes. But I don't know. I don't think we're not going to go through that same bubble that we did in the early 2000s. I sure hope we don't. Now, how about, is it liquid or illiquid? It turns out they're very liquid, folks. Bonds are like stocks. They can be bought and sold at any time. However, unlike stocks, bonds do not trade as often. People tend to buy their bonds and just hold on to them for the income. But that's not to mean they aren't traded. They are. How about a duplex in Spring Valley? You rent one and you live in the other. Huh? Security? Yeah, you know what this is. It's property. Right. It's real estate. Debt or equity? Equity. You own it. Direct or indirect? Direct. You're in control. Your name is on the title. Your name is down at the county admin building as the owner of this property. Is it domestic or, Spring Valley, yes, is part of San Diego County. Short-term, intermediate term, or long-term? In my humble opinion, folks, real estate is always a long-term investment. You might say, okay, I'm going to fix it up. I'm going to sell it in a few years. Good luck. If there's a downturn, you never know what's going to happen. You never know what's going to happen, but it's going to happen. You might have a hard time selling your property for more than you paid for it. So I would hope that you would think of real estate as long-term. Is it low, moderate, or high risk? Well, a lot of that depends on when you buy. As long as you have a long-term investment time horizon with real estate, I would categorize it personally as moderate. Although if you're looking to flip, as they use the term flip real estate, I would consider it very high risk. And if you buy during a downturn, if you're lucky enough to be able to qualify for the loan and have the down payment and can get the bank to listen to you, it would be considered a low risk, in my humble opinion, because it's not as though San Diego is becoming less desirable to live in. Yeah, indeed, right. Have you ever spent a winter in Buffalo, New York, or Youngstown, Ohio? I'm from Philadelphia, and I tell you, folks, the weather is evil there. Food's good, though. I miss the food. Is it liquid or illiquid? Aha, you know. Real estate is our poster child, our archetypal illiquid investment. Okay, so you got these. Oh, wait a minute. Just one more. How about the loan to Uncle Harry? Every family has an Uncle Harry. And he's in trouble again, and now it's your turn to bail him out. Is it a security or property? Well, it's a security. It's not very secure. You're lending him money. So what is it? Debt to equity? It's debt, yes. You own the debt. He has to pay you back. Is it direct or indirect? It's direct. You're stuck with it. Is it domestic or foreign? Well, so far he's still living here, but who knows when you're going to get a postcard from somewhere outside the country. Is it short-term, intermediate term, long-term, or, whoops, wrong one. Or is it, whoops, forever? Yeah, it's long-term. He'll pay you back. Don't worry. He told you. He told me he was going to pay you back. Low, moderate, or high, or speculative. Yeah. Illiquid or illiquid? Well, yeah, it's very illiquid. Nobody wants to touch your loan. You're not going to be able to sell it to somebody else and have him owe them because they're not interested. You got stuck with it. So hopefully now you have a better idea of what kind of investments there are, what are the major categories, attributes, characteristics. Because when we come back in our second presentation, we're now going to go in a little closer. We're now going to take a closer look, but not very close, folks. Still, we're still looking from far away at the major asset classes: stocks, bonds, mutual funds, real estate, derivatives, short-term investments, and we call it the overview of the investment universe. So let me summarize by saying again, we are incredibly honored that you are here with us. We are going to do our best to make this the best class you've ever taken, and we're going to do our best to make you very wealthy over time. You're going to go back and study the major characteristics of the different types of investment alternatives, and be able to identify, which ones go with which categories. And then, as we continue, we're going to get closer and closer and get into more and more detail. So, you excited? I hope so, because I sure am. And remember, I can talk about this a whole lot longer than most people would ever want to listen. So if you ever have any questions, do not hesitate to ask me, because I simply adore this stuff. And who knows, dear students, there could be, maybe in your future, a position in the industry. Huh? Yes, the industry is going to lose tens of thousands of people to retirement soon, in the next 5 to 10 years. And they need young folks. They need people coming in as stockbrokers, financial planners, insurance agents, loan officers at banks, real estate financial investment professionals such as mortgage brokers and appraisers and the like. So there's a future for you in the industry. They want more bilingual, more minorities, more women. They love ex-military. So we're going to touch on those also. And again, let me say that I'm going to do my best to make this the best class you've ever taken, and a class that 5-10 years from now you can come look back and say, that class really helped me in this crazy, scary, joyful, absurd, bizarre adventure that we call life. See you in our next presentation. Welcome to Business 123, Introduction to Investments.